Our January look up 0.2 on headline strip out autos, jumps up to 0.9. Strip out autos and gas 1.2, and the control number plugged into numbers higher up the stream 1.1. Now I'm going to start with that 1.1. This is January. Our last look was minus 1.7, which was the worst control number going back 19 years. But it just got worse on the revision to minus 2.3. And last month's minus 1.2 that there was so much debate over ends up worse at minus 1.6. But these data points are definitely much better, obviously, and we're going to continue to monitor that soft patch that we seem to be transitioning from. Rates holding steady at the same levels. So we're going to wait for business inventories at top of 10, but my guess is supply this week, 3s, 10s, and 30s, may give us a better glimpse, especially considering some of the significant drops of our competitors on the sovereign debt side outside the U.S. Andrew, back to you.
Okay, Rick, thank you for that. Steve Liesman has taken a look at those numbers and nodding his head in some kind of
We will be puzzling for years, maybe, about what happened to the consumer in December, right? Low unemployment, strong wage growth. What did they do? Retail sales declined by 1.6%. And honestly, I still sort of don't believe the numbers, in part because, remember you had Etsy on here the other, what was it, Friday?
Yeah.
What did he say his Christmas sales are up, like 30%?
Huge.
Some ridiculous number. So I have the non-store retail number here down 5% in December. You had Amazon report good numbers. Right. So I have my suspicions that a lot of stuff has moved over to the online place and the government's not capturing it. That said, you did have a bit of a rebound in January, did not make up for what happened in December. 2.6% on non-store retailers. The control group, which feeds into GDP, was 1.1%. But we're going to take down fourth quarter GDP, I think, a little bit more. And I don't know that because of the way it's done that you'll actually build it back very much. But I want to talk about something else, which was a fascinating reaction I got from over the weekend, economists to the payroll number. They routinely dismissed the weak payroll number over the weekend. Instead, they keyed in on the strong wage growth number. Here's Pantheon. Our friend Ian Shepperson writes, the 20,000 increase in February payrolls is not remotely indicative of the underlying trend, and we see no reason to expect similar numbers over the next few months. We expect 4% wage growth by the end of this year, and that's hard to square with the market's collective view that the Fed has finished hiking in this cycle. J.P. Morgan says a tight labor market is putting upward pressure on earnings. And Morgan Stanley says this, quote, the impact from higher costs is definitely starting to bite. Specifically, consensus EBIT margins, that's earnings before interest and tax, expectations for 2019 have fallen by 70 basis points since October. That's the biggest decline since the earnings recession in 2015. And they say that it's not necessarily what it is. They think the tax cuts into the full economy have really pushed this up, which is a good thing. But over time, you're going to have this reaction if productivity doesn't rise to it. So it's an interesting question or an interesting explanation for what's happened first to profit margins and expectations and then for the outlook for profits this year. It's okay if you have this wage increase comes at the expense of profits. The problem for the Fed would come if companies move to protect their profits and their profit margins through raising prices, and they are successful at it.